let me tell you one thing. I had the honor to listen to what you were saying, and it was so good for everyone out there who's not into trading. I would recommend you to listen to it anyways, because it's so applicable to your life too, about values and about assets. So I was impressed, bro. So therefore, thank you for that too.
Thank you very much. Okay, so I have this in my hand just to have some notes because I don't want to lose pieces. Now, this should be a trading masterclass. I'm not doing anything technical because I assume none of you trade actually, except for you. I know you are trading now. But I just want to give you a bit of understanding about what finance is. It is a field that is so much poison these days. There is so much garbage going around. So I just want to show you what really it is and make you think logically about what should be reasonable to do and what should be reasonable to believe and so on. So, in general, I call this the truth about trading, cause versus effect. It is a very guru-like title, but I'm not trying to do anything strange. General idea is this. What is the most common misconception? Other than the fact that trading is a scam, and I can assure you that if you go on TikTok and Instagram, 99% of the time, it actually is. It actually is 99% of the time if you go around in the public. Another big misconception is that most people think that traders are just gamblers or parasites. One of the things that we can see that people believe, this is usually what the leftists really believe, is that traders, like finance people, are just basically either gamblers or parasites. They're just speculators that make money basically on market fluctuation. But this is not actually true. They think they don't provide any value to the real world, but this is not the case. And what I'm about to show you now, it is what made me change the way I approach trading, what made me actually the man I am now in finance, and I'm pretty sure it will change also the way you see maybe money itself. So, before we go on, just a bit of context. Now, some of you know me, most of you don't, but this is also going on YouTube, so I need a bit of context. So, I am Raffaello, I'm 24, I trade since 7 years, I study pretty much anything, and as of now, I manage over 5.5 million for an hedge fund. So, I am actually an asset manager. I don't work with prop firms that you see on Instagram. I actually work with a hedge fund, with an hedge fund. I am regulated, I have an European and English regulation, so I'm actually doing it in the professional way, not the Instagram way. I just started my personal brand. I wasn't public. My private Instagram is still private, so I never try to sell anything. I never sold any course or stuff like this. I make actually my money from trading itself. So as of now, what enabled me to actually manage this amount of capital after, as I said, I studied for 7 years and I studied everything you can find around in any language. I studied English, Italian, French, Portuguese, Spanish. I don't even speak good neither Spanish nor French. I studied everything I could find basically. And what changed the way I approach it is what I'm about to tell you today. So the first thing, the only open question I have for this presentation is what makes a transaction happen? What is the main thing that's needed to clear a transaction? How do business owners like you or professionals actually earn a living? At what metric does any person apply to evaluate if spending money makes sense? What is the thing that is the common factor between all those things? What is needed to actually create a transaction? No one.
Value.
Value. First one, value. To clear any type of transaction, to earn a living, to make money in a capitalistic system, you need to actually generate value. Money follows always value. You only spend money if you think that what you're getting is more valuable than the money you're giving up. You only spend money if you think that what you are about to receive actually has more value than the money you could use to do something else. This is known as cost opportunity in economics. Okay, so money always follows value in a capitalistic system. Now, the value that traders create, it isn't a product or a service, but it is equilibrium. Traders create equilibrium. Traders bring value to the world by creating equilibrium. And how they do that? What traders actually do is providing motion to prices, to assets, to bring them back to what is called fair value. So when an asset price drifts away from what the economist justifies, so this is the actual fair value, when there is a gap between the current price of an asset or a good or anything, And this is different from the fair value. Traders step in. Now, we'll get back to fair value soon, right? In a capitalistic system, as I said, wealth can only flow to where value is created. And the value that professional traders create is actually pricing efficiency. They help the economy to self-correct, right? Now, traders basically act as supervisors, okay? They indirectly, through speculation, they ensure that an asset is priced fairly, is correctly priced in. So when something changes, when there is a big move in the economic world and the theoretical fair value of any asset or any good changes, traders step in, and by applying speculation, by making money of it, they indirectly make the price move, and they just provide equilibrium to the economy, basically. So the core concept here is the fundamental shift. Again, a fundamental shift is when something real changes in the economy, like changes in production, inflation, interest rate, growth, and so on, employment. When this change takes place, the fair value of a currency or an asset changes, okay? Price then spend days, weeks, or even months to rebalance, then to move and to go to the new fair value. And this is what actually creates market trends. When you see on a chart a price going up or going down, what traders actually call a trend, this is actually a rebalancing. This is the price going to the new fair value. So trends are not magic. They are not some kind of technical concept you need to study. No, they are just rebalancing, okay? So there is no random trend in the world. The price can change because there is some rectangle or line or triangle or anything on a chart. Anytime something moves in the market, it is just because there is a fundamental shift happening in the world. Without this, nothing absolutely moves. No, why pure technical analysis, or the approach that you have by looking at charts, the most common approaches that can logically work in the long term? Because retail traders, they use probability to pay rent using technical analysis. Why is that? Because technical analysis, and in technical analysis I include pattern indicators, even smart money concepts, ICT, fair value gaps, all these things. They are just different skins of the same game. They're just repackaged technical analysis. And this is actually what is called in mathematics is a stochastic pattern matching. Now, to make this clear, I have an analogy. If you don't know what an old almanac is, almanacs basically were these books that farmers mainly used that had all informations about weather, moon cycles, and records when it actually rained. So the logic was, okay, in the last 10 years, in the last 10 years, on the 5th of September, it rained. It's logical to expect that this rain on the 5th of September will rain again. So this is how actually almanacs worked, okay? The idea was if an X event happened multiple times in a row, it is logic to expect that the same event will happen again. This is a stochastic way of approaching, and technical analysis is basically pretty much the same thing. That's in fact technical trading. Patterns, and as patterns I assume rectangles, order blocks, trends, indicators, are assumed to have power simply because they produce a certain effect in the past. They don't have nothing that is inherently, that has value inherently. They just are a way to see the market in a stochastic approach like an old almanac. Sometimes they work, and this is either by coincidence, because maybe there are some fundamental metrics happening, so there is a fundamental shift happening in the same time, or because there is just actually some statistical advantage to it, but the pattern itself has no causal power, not casual, causal power. Retail traders, so like this, are outsourcing their future on the shape, on a shape on a chart that's just happened sometime to work. Now, what they do now with weather forecasts, they use something that is called deterministic thinking. Modern meteorology doesn't guess from history, but they use mathematical models that are called deterministic. So they are actually studying cause, they model cause and effect using this kind of deterministic approach. What this means, a deterministic approach if you use a deterministic approach, you need to actually have drivers that you can actually use to predict outcomes. For example, now they study clouds, they study winds, they study pressure. So if there are actually clouds 10 kilometers from here, the pressure is good and the wind is blowing to our direction, they assume, okay, now on this part of the world at that time, it is logical that it will rain. So they don't study actually the effect. Using the almanac, you study, okay, it has rained these multiple times, and so I assume it will again. Using a deterministic approach, you actually study the causes of the rain. And this is how they actually do. From inputs, they go to outcomes. Even though they are never perfect, because weather forecast misses some time, they are way, way more precise than almanacs, because they are rooted in drivers, in causes, not effects, not recycled patterns. And this is what professional trading also does. They mirror this. Professional traders don't look at a chart, but they study the drivers. They model macro inputs like GDP, inflation, central bank expectation, trade balances, policies, to predict the most logical outcome. The technical chart in that case is not forbidden, but it acts just like a confirmation. We call it a timing instrument. It's something that helps you understand when it's actually logical to enter, but the overall bias, 80-90% of the bias, is done with fundamental analysis by studying drivers, by studying causes, not effects. Okay? Now, the core belief is this. In anything, in laws of nature teach us that cause is first and effect is always second. Narrative is first, then execution is second. The professional edge traders have, funds have, comes from the cause, not from the effect. And what retail traders do is actually looking for an edge by studying just the effect, not the cause. Now, since we are all entrepreneurs, I assume anyone likes cars here, and we have Chris, so I just did a Formula One analogy to explain it better. So the idea is this. Technical-only trading is basically like predicting the outcome of a Formula One race by staring at the front wheels through a zoom lens. So it's like we're looking at the race with just this kind of picture. Yes, if we see the wheels turning left, sometimes the car will go to left, but it's not always like that. Other times, the same left turn is just setting up for a sharper right 2 seconds later. So if you look at a Formula One race just by looking at the wheels, most of the times you will actually get fucked, because usually what cars do is just they take a left to just take then a sharper right. This is what you are doing with technical analysis, what you are doing by studying the effect. The wheels that are turning are the effect of the idea of the driver that needs to follow a racing line. So this is exactly the same thing. Now, when you do this, an observer might actually guess right occasionally, but they are relying on luck, and they'll be late or wrong most of the time. This is the logic. Now, professional traders in that case don't stand trackside with a zoom lens like in the previous example, but they fly an helicopter. They look at the race with an iBird view. They look the entire track layout. They can see the whole car, and they still glance at the front wheels, but just for timing, just to understand when the car is actually about to turn, just like technicals are used to fine-tune entries in professional trading. But the true direction is given by the bigger picture. It is given by the bigger picture. So, of course, if all one sees are wheels twitching, there is no way to distinguish between a defensive maneuver or a setup for a future sharp curve. But from above, every move has context. That's exactly the difference between retail trading with technical analysis and using fundamental analysis like banks do with macro inputs. Now, of course, even in that case, the car can always lose control. The car can always go outside of the track. But even like this, even with this scenario, your chances of actually understanding where the car is going are far, far greater. This is because nothing in finance is scientifically perfect. Every approach, even the one banks and I use, it's called the global macro approach, they are just theories. There is no scientific proof of anything about economics. All kind of approaches, the one hedge fund, the one Goldman Sachs, BlackRock, anyone uses, it is just a theory on a way to read markets and predict markets. Why? Because, Why? Because markets are driven by human, not by algos. Humans come with emotions. Now, one of the biggest misconceptions is that, and it might sound funny if you don't actually trade, but this is one of the most famous way to trade right now, smart money concepts, ICT. They basically believe that the markets are moved by some sort of algorithm. They call it the IPDA, Institutional Price Delivery Algorithm. It is basically a fucking conspiracy theory that tells that market is moved by an algorithm and then the markets follow some certain patterns. But as crazy as it might sound, and I hope it sounds crazy to you, but it is like the most famous way to trade as of now. All the big influencers you know about trading, biggest one, they use this kind of approach. And it is just as crazy as it sounds. But markets, in reality, are moved by humans. We have some kind of algorithm in markets, but this is for high-frequency trading. It's the microstructure trades that goes over the, like milliseconds long. It is now a complex. It is a complex thing. This is what I based my thesis for my economics degree. But I'm not talking about it because it's very, very much complex. You don't need that. The idea is that markets on the bigger picture are always moved by humans, and humans bring emotion, they bring fear, greed, overconfidence, herding behavior, they have bias, recency bias. That's why there are bubbles, and bubbles inflates, then there are collapses that can happen overnight, and the entire market sometimes can stay irrational for a long time because it is driven by human, and humans are unpredictable. This is why we don't have a scientifically proven method to approach trading, just because trading is made mainly by human, and human behavior is very, very erratic. It's very hard to actually understand and predict. Now, technical patterns, as I said before, sometimes work not because they're magical, but because maybe at that moment they line up with an actual fundamental shift, with an actual fundamental reason or mass psychology. Markets can stay insolvent, can stay irrational. It happens all the time that markets are just wrongly priced, even though, for example, drivers, economic drivers like GDP, inflation, tell you a different story. Markets can be priced in a different way because they are made by people, and people, as we all know it, are irrational, right? Now, over the long run, any strategy or approach that ignore the cause and rely only on the effect eventually lose. In trading, anything can work and anything cannot work. There are people that I know personally that made a living from trading by using technical strategies. The thing with this is that they are not constant, they are not sustainable over the long run, because yes, something can work even for extended periods of time, but when that statistical edge doesn't work anymore, they don't have actually the instruments to analyze the markets again and understand where to look, what strategy to use, what approach to actually implement. If you lack this kind of perspective, you can win small battles, but over the long run, you lose the war. Now, the study of fundamental analysis is what allows traders to understand how the world truly moves. For example, if you study economic history, you can see also on the political standpoint that economic history teaches us that when there is high unemployment, high inflation, lowering wages, usually people are keen to elect extremist parties, both on the right and on the left. This is why, for example, the election of Trump, the election of Meloni in Italy was very, very clear to me, because in situation of economic distress, people tend to go to the extremes, either left or either right. Economics drives the world. It is not, I'm not saying it's good. I'm not saying the capitalistic system is the best system we can have. It comes with a lot of disadvantages, of course, like anything in life, but it is what made possible for all of us to be here, for all of us to not have died from some fucking illness. So this is what moves the market, and this is what moved the world. The economics moved the actual world. Economics opens eyes. It reveals that in that case, patterns of technical analysis or head and shoulders or the blocks, all that shit, sometimes appear to work, as I said, only because it aligns with macroeconomic factors, but it is purely a statistical coincidence. But the pattern itself is not the cause, it is only the echo, it is only the effect. And if we rely just on studying effects, we are bound to failure, basically. Now, as I said in the beginning, the role of a trader it is to create value. It would not be possible. Finance is one of the most profitable fields in the world. It wouldn't be possible for it to be this profitable if there wasn't actually any value that was created. What they do is spotting fundamental shift earlier and help to correct the price. If, for example, you have a coffee shop and you are selling coffee for €2, and tomorrow there is a drought and coffee beans prices spike, doubles overnight, of course, after some time, you will have to adapt. Coffee will be now priced in at €3. And this trend that happens is just rebalancing. Because the thing that some people forget when talking about finance and markets is that markets are actually, guess what, markets. They do not move because of speculation. Speculation is just the visible effect. They move because they are constantly seeking to rebalance. They are markets, so they exist as center of exchange. They are not made to just put trader in and speculate. Markets are actually the place where buyers and sellers meet. And an asset price is given only when a seller and a buyer agree to transact to a certain price, a level that they find acceptable. This is the definition of fair value. Fair value is a price where seller and buyer are happy to transact. When there are some underlying causes that shift this perception, this is when price moves. This is when trends happen. If you don't have this, price have no actual reason to actually move, because markets are created to have the encounter between buyers and sellers. If you analyze it just by perceiving it as a speculation ring, you won't be able to understand what makes really markets move. So, of course, fair value shifts only for fundamental reasons. If a good becomes scarce, for example, like the coffee beans, and if demand rises while supply falls, the buyers compete to secure a price, and the price ends rise. Capitalist markets dictates that scarcity pushes price up and vice versa until a new fair value is established. On chart again, the repricing appear as a trend, a directional move, what professional calls a fundamental shift. This is what makes the markets move. So a trader adds value only by spotting this change early and by facilitating the price journey to the new fair value, by carrying price from disequilibrium back to fair value. And this can only be done by analyzing the causes that move the fair value, not by staring at the effect. If you just look at the effect, at technicals, at patterns, you are not actually providing any value to the market. You are not adding value to the world, because you add value just by spotting this situation when an asset is mispriced and acting accordingly. This is the caveat. This is the most important thing. This is why logically technicals can't work over the long term, because you are not actually adding any value to the world by using a stochastic approach. By using a deterministic approach, you are helping the market to rebalance, not because of a fucking pattern, but because there is an underlying cause that make the move. There is an underlying cause that make the move reasonable. This is how traders create value. This is how actually money are created in finance, and this is why finance is one of the most profitable fields in the world. If value is not created, logically, by fucking laws of nature, you can't possibly make money over the long run, because that's when you are a parasite. That's where you're just making money on mere speculation, and you are not making money because you are adding value to the world. So this is pretty much it. Markets are not casinos, nor traders are parasites. They are part of the mechanism that make economy work, that keep the economy balanced. And the professionals who understand this know that this is done by understanding and studying the causes and not the effect, never the shadow. The market does not reward those who chase patterns, it rewards those who see the shift before it becomes obvious. And think of this not as a trading rule, because I'm pretty sure most of you don't care about trading, and you are lucky for that, I guarantee you, because it's very stressful. But see this as a mindset shift. Entrepreneurs, so all of you, understand that the markets of goods and services follow value. Traders apply the same exact concept to markets, but they do it by applying to money itself. So value is only created where something is added to the world, not when something is just taken without providing anything. And this is what we do. They just apply the same principle an entrepreneur apply, but to money itself. This is it. Clear? Any questions?
Can I ask a question?
Yeah.
Did you experience many occurrences when you tried to apply the almanac analogy when the car got out of control with the use statistical reasoning to make a prediction? And if so, how did you go about figuring out what went wrong?
So the general idea is that I use the stochastic approach like everyone does for a lot of years, like 3.5, 4 years. I traded for 7 years. Back when I was 17, I started in high school. And yeah, for the biggest part, I use this kind of approach. And over the long run, things can work. But the second something changes, they stop working. And if you don't know why you're actually giving power to that specific pattern, you can't readapt, you can't rebalance your approach. So the stochastical point of view, it is interesting and it is valuable only when it aligns with actual fundamental reasoning. So in that case, yes, I had multiple occurrences before finding my framework, my approach with fundamental analysis, where I would just lose money and I wouldn't understand why. That's the biggest thing. With fundamental analysis, you can understand why you got it wrong. If you have a bias over an economy and this bias is unconfirmed, you can actually understand why. You can see where you lost, where you made a mistake. If someone just teaches you, okay, when you see this kind of rectangle on a chart, you should buy, and you lose money, you can know why it is not actually working. There is no reason behind it. So using only a stochastical method is preparing you to fail because it just doesn't make sense. I said you don't create value. So yeah, this is pretty, did I answer to your question or was it different? Yeah.
So did you figure out an optimal strategy that you use?
I have a framework, yeah. It is adaptable. Now the framework I use 17 different data points, economic data points. I have my own trading terminal that basically by an algorithm gives a score to each of these drivers and then gives me a normalized score for each currency. I trade currencies mainly. Giving us a macro score for each currency, I have my bias. Then I confirm it with statistical analysis. For example, my algorithm gives me the theoretical fair value of an asset. As a stochastic confirmation, as a statistical confirmation, I have that for a trade to make sense, the current price must diverge from the fair value by at least one standard deviation, because this makes sense. It makes sense that a strong move will push the market because the divergence is very high. So this is like a statistical confirmation I have. I have other stochastic confirmation, like what they call institutional nodes, that are psychological levels that are actually used in banks to understand when something is cheap or when something is expensive. So yeah, it is part of it, and it's a good part of it. But the whole bias comes from actually cause and effects, from cause, not effects.
Thank you. This is very interesting.
My pleasure. Yeah.
Would you say that tying technical analysis to real market news could still work? I know not long term, but like you can still see some good effects of just tying the actual market news, like Red Folder news, ICT, when the government is speaking, things like that, to taking trades and not taking trades?
So this is unique. So the thing is, markets are forward-looking. They move on the expectation of the news. So if we have a news coming out, like an interest rate, and the market consensus is that the central bank will rise interest rate, the market will price this in before the actual news. So if I'm expecting the Federal Reserve to cut rates now in 2 weeks, the markets will already move through a cut. Then you have the big spike on the news, just if the actual number that comes out is very different from the general consensus. So this is one mistake people do. News don't move the market. It's the expectation about the news that move the market. Markets are forward-looking, so anything is the market is a reflection of all the expectation of the most prominent investors inside the market. So tying this with technicals could give you a bit more of an edge, but the thing is, fundamental analysis is not just a thing that you study and you get figured, because economy as a whole is not difficult. It is complex. There are a lot of things, but it's not rocket science. Before economics, I studied engineering. This is our thing. Those are our things. Economics is not dumb, but it's not difficult. It's not hard. It is just complex. You have so many things. You can know everything, but if you don't have an actual framework that tells you how you should weight every little driver in, you just can get lost, because you can have multiple drivers that tells you opposite thing. Even in fundamental analysis, you need an actual framework to do this. So if you just study macroeconomics by a university textbook or anything without having an actual framework, it is possible that your trading performance will just deteriorate, even as it sounds not logical. The thing is that with as much complexity there is, you can just, it's easy to make stupid decisions because you fail in looking at the broader picture. This is the hard part about economics, not the concepts. The concepts are fairly stupidly understandable. It's not hard, it's not rocket science. The difficult part is actually being able to use all of this without drifting into chaos.
Makes sense. Good.
Right, you've got a pot of money. Okay, you're someone who kind of knows vaguely about trading.
Yeah.
Where do I even start? There's so much information, there's so much, like, when you sit down, what do you do? It's the first thing you would advise someone who's got a little bit of money to do when they sit down and they want to start investing or trading.
First, understand how money works, first thing, because like it depends on your objectives. You're asking this in the best of someone that wants to trade or someone that maybe is a business owner and wants to invest their money.
Let's say, run both scenarios.
So the second scenario is the easiest one. If you are a business owner, you don't need to actually trade. You just need to invest in index funds, in my opinion, or in other type of economy. You can have a 8 to 12% return, usually, on the S&P 500. You can just put the money there. You don't need to make 30% a year. Now, mind you, the kids screaming on Instagram, they claim that they make 10, 15, 20% amount. This doesn't exist. In finance, the overall objective of fund is beating the market benchmark that usually is the S&P 500. So it's making more than 10, 12% a year. This is the idea. So it's like 1.5% a month. So if you are a business owner and you don't want to trade because it is a fucking full-time job. So it's not something you can do like this. Traders are one of the most paid professionals in the world. And just like a doctor studies for 6 years to become a doctor, you don't just go on YouTube and search quick ways to do an ear transplant. You don't do this. Now, I'm not comparing finance with medicine. Medicine is far more important, but you just need to approach it in a proper way. The first thing I would do if I were to start all over again was to go into fundamental analysis directly, because this would have saved me 4 years of my life. Tens of thousands of euros. I was lucky enough that I have other two companies, always into finance, that made me able to actually have money to invest in trading, to invest in myself, but that would have saved me maybe 60, 70K. So yeah, just start with that and try to understand the root causes, and then you need to build a framework out of it. You either can do it by yourself or you can find someone that already does it. But the overall idea is using fundamental analysis, trying to understand, because if you want to learn how to drive a race car, you go to someone that used to race car, not to the guy in your town that has a piped Alfa Romeo and just drives fast around the corners in the town. You go to professionals. So the best idea is to see what professionals do and try to mimic them. And what I can guarantee you, you can go look it, because most of researches are public. If you look for Goldman Sachs, Credit Agricole, Spectrum Markets researches, they're public. They all use fundamental analysis. You will never see in a research a fucking order block. You will not see a Fibonacci, a moving average. You will never see this. The easiest thing to do, the most logical thing to do, is understand how big players are actually doing, not the kids you see on Instagram that rent a Ferrari and do wheelies in Dubai, like we did. Yeah, like we did in March.
Okay, cool. And then why? Because you've got a couple of degrees, don't you now?
Yeah.
Shout out to Raf, by the way, guys. You got an economics degree, his second degree. What was it? Last week or something?
It was the day before we came here.
Yeah, that's
10th of September. University is stupid. Don't do what I did. I did it just because my parents are teachers. They care, and I wanted to make them happy.
I was going to ask, why did you do them?
It was because of this. It was because, yeah, I didn't learn actually any fucking thing from the university. Nothing.
I thought you were going to be like, oh,
absolutely.
I did it because I wanted like a degree to prove that I could.
No, it is, honestly, it is just to flex. Like, it is cool to say, yo, I manage 5 mil, I'm 23, I have a Ferrari, and I have 2 degrees. You know, it's cool to say. But no. Engineering and economics, yeah. software engineering and economics. But you don't need that. You don't need it. Literally, nothing that I learned in university actually was useful to me in trading. Nothing. Zero. Like, for example, also for the other companies I have that are fintechs, or we create trading systems and CRM for brokers. So maybe the software engineering could be up. No, it isn't.
Right.
You can learn anything for free now. So yeah.
All right, guys, any final questions for us?
Anything else? Good?
Well,
Nice.